Let's start with a quiet fact. Your retirement is a liability on someone else's balance sheet. It's a future debt, a promise to pay, and the institution that holds that promise has one job: to make sure the money arrives. The way it does that is not by guarding your contribution, it's by transforming it. Your money becomes a tiny fragment of ownership in thousands of companies, in office blocks, in toll roads, in government bonds. It becomes a citizen of a vast global network. And this network has a single, non-negotiable directive: growth. Your financial future is therefore hitched to a fundamental belief: the belief that the global economy, in aggregate, will be larger, more profitable, and more valuable 30 years from now than it is today. Not just once, every single year. A quiet bet on perpetual expansion. Now, on its face, this seems reasonable. It's the story of the 20th century. But a bet is most revealing when the conditions change. Consider the mechanism. Your pension fund needs Company X's stock to appreciate. How does Company X do that? Two primary ways. One, innovate, create new value, the good way. But innovation is hard, unpredictable. So there's way two, financial engineering. Improve the metrics, boost earnings per share. A reliable lever for that is the stock buyback. A company uses its profits to purchase its own shares from the market. Fewer shares outstanding makes each remaining share more valuable. The math is impeccable. The stock price ticks up. Your pension fund's returns improve. The machine is fed. But follow the logic. Where did the money for the buyback come from? Profits. And what could that capital have done instead? It could have raised wages, invested in research, built resilience. It was a choice. And the system, through its relentless demand for growth, rewarded one choice over the others. Here is the quiet conflict. The system funding your future systematically rewards corporations for prioritizing share price appreciation over other forms of investment, over the very things that might create a broader, more stable, more equitable economy from which to draw future contributors. It is a closed loop. It incentivizes efficiency over employment, shareholder returns over stakeholder durability. It is, in a very real sense, betting against a future of robust, widespread labor income in favor of a future of exquisite capital returns. And your security depends on the latter winning, decisively. This is not malice. It is mathematics, a frictionless, self-reinforcing arithmetic. When growth is effortless, the tension is invisible. The river meets the dam. But when growth becomes strained, the machinery groans. The assumed rate of return, that magical number baked into every projection, becomes a prayer. And the options are all austere: increase contributions, decrease benefits, or seek riskier forms of growth, double down on the bet. So, the next time you see a headline about record corporate profits alongside a wave of layoffs, or a multi-billion-dollar buyback program, do not see two separate news items. You are seeing a report on the weather, for a wager you didn't know you made. A wager where the prize is your quiet years, and the collateral is the world you'll spend them in. The bet is running. It has been for decades. The only thing left to determine is what it costs us to win.